Welcome everybody, my name is Joe, and this is a stock market explanation video. This is to help people get started investing in the stock market. I'm going to cover all the basics, all the essentials that you need to know to make wise, informed decisions. Now, if it goes too fast for you, just hit pause or rewind, whatever you need to do. But just know, it may seem intimidating, but you'll see at the end of this video, the stock market is not that hard to understand, and it's not that hard to become wealthy if you're consistent and you're in it for the long term. Let's get started. Okay, so here we go. Let's start off with some transparency. I'm going to show you exactly how much I have invested in the stock market and where that money is invested in. You'll see at the first photo, I have $15,000 invested in my 401k in my old company and over $24,000 invested in my 401k in my current company. So that's $40,000 invested in the stock market. But both of these 401k accounts are all invested in one type of fund. Later on, I'll show you what fund that is. As you can see, I'm 30 years old. Let's say I plan to retire at age 59. If I just continue to invest $300 a month and make 10% a year on that money, I will retire a millionaire. Okay, let's start off with the basics. A private company who wants to get listed on the stock market has an IPO, initial public offering. This allows people to buy into their company and buy shares or stock. Once you're on the stock market, you don't have your entire name of the company listed. You just have your ticker symbol, your nickname, your short name. For example, Apple, their ticker symbol is AAPL, and then every stock will have its own price. So let's look at that a little bit deeper. A share or a stock of a company, just think of it as a piece of a company. So you look at this circle. These are small pieces that together make a whole company. When you buy a stock of a company or a share of a company, you own a piece of that company. If you wanted to buy a share or a stock, you have to pay the price for that. For this particular example, the price is $100. Now, that one stock that you bought can rise in value. Now, what causes a stock to rise? Well, organizations and people buying a lot of shares of it. Now, why would they buy a lot of shares of a company? Well, they think in the future, the company will make more money than it is making now. In the inverse, that same stock that you bought for $100 can go down, let's say, for example, to $95. And what would cause it to go down? Well, a lot of organizations or people are selling shares because they don't believe in the future as much as they did before. So if you bought one stock of $100, it rose to $105, and you only bought one stock, you just made $5. If you bought two of those stocks and it went up $5, you just made $10 profit. So you just continue to multiply that to see how much profit you would make. And the reverse happens when the stock goes down. If you bought it at 100 and went down $5, that one stock that you bought, you just lost $5, or two stocks, $10, and just continue to multiply it. Okay, so let's talk about earnings. You'll hear that word a lot in the stock market. But basically, that's all the leftover money that a company has after paying out its taxes, all of its expenses and bills. This is the leftover money. Now, what a company might decide to do is to pay a dividend. A dividend is a regular payment to shareholders. So if you bought a share, if you bought a stock, if you bought a piece of the company, you are a shareholder. So let's look at an example. If a company announces that they are going to pay 15 cents per share and you own 100 shares of that company, you will receive $15. That means that just for buying the stock, they're going to give you some of your money back. Now, not every company pays a dividend. Typically, the larger, more established company pays dividends. The smaller, upcoming, fast-growing companies tend to want to reinvest their earnings back into the company instead of giving it away back to shareholders. So this is a quick view of the dividends that I received in one of my 401k accounts. As you can see, it was paid every 3 months. So this is the money that I received just by being invested in the stock market. Now, typically you're given two options of what to do with the dividends that's deposited in your account. You can reinvest that money that you received to say, okay, thank you for the money, but you take it back because I want to buy more shares with that money. Or you can pocket that money, keep it to yourself. You can take it out of your account and spend it how do you like. I personally always, at this point in my life, reinvest those dividends to buy more shares. Maybe when I'm older and closer to retirement, maybe I'll start pocketing the dividends, but I want to grow my portfolio. I want that money invested back into the stock market to make me more money. Okay, so how do you go about purchasing a stock or a share in a company? Well, you open up a brokerage account. You can even invest in stocks by using your bank. Let's take a quick look at a stock page. So if you enter in your ticker symbol, Apple is AAPL, then it will populate the stock page for that company. Over here, you'll see how much one stock for that company will cost you. Over here, it will show you if they pay a dividend, and if they do, how much they'll pay you. So this shows that when it's time to pay their dividends to its shareholders, they are going to pay you 20 cents for every share that you own. Down here is where you can stay updated to what's going on in the company. We don't need to cover everything that's on this page, just those basic essentials for now. So let's talk about mutual funds. You've probably heard of them. A mutual fund allows investors to purchase a large number of investments in a single transaction. So let's say you wanted to own these particular companies. Instead of buying shares in AT&T and then going to buy shares of Shell, buy a mutual fund that holds them already and you pay one price for them. Here's an example of one mutual fund that you can buy into. Their ticker symbol is VFIAX, and this is the price that it's going to cost you to buy one share. Often you'll find mutual funds have a minimum investment criteria. Their criteria, for example, is $3,000. There are many different types of mutual funds that you can invest in. You can find very safe mutual funds that won't go down too much, but it also won't go up too much. Or you can find a mutual fund that's super risky, super aggressive, that can go down a lot, but also can go up a lot. But one unique thing about mutual funds is that they allow you to do automatic withdrawals or automatic investments. So if you want to have a set amount that you want to invest in the stock market in the mutual fund every month, you can do that with a mutual fund. How does a mutual fund make money? Well, because a mutual fund has a lot of different investments inside of them, how those stocks or investments do together will reflect how much the mutual fund goes up. Another term that you may hear is the ETF, Exchange Traded Fund. It's very similar to a mutual fund. Just know one common difference in an ETF is they don't have minimum investments. So you can buy, for example, this ticker symbol, VOO, which is a ETF, very similar to that same mutual fund that we spoke about, but it doesn't have that initial investment requirement. Moving on, let's talk about indexes. These three indexes are the indexes that you will commonly see on the news. You'll hear that the Dow dropped 500 points, the NASDAQ rose 300 points, and to many people, they have no idea what that means. Well, just think of an index as a large list of stocks. So how they go up or go down collectively as a group will determine how much that index goes up. Each index has its own formula and its own list of stocks that it tracks. And they take a bunch of different stocks and transform them into one clean number. Let's zoom in particular to the S&P 500 index. This is a list of 500 companies. You can see down here, these are the ticker symbols for those companies. So how these stocks perform as a group will determine how much this index goes up or down. Now, the news typically mentions these indexes just to give you a quick view of how the stock market is doing, generally speaking. Moving on quickly to lessons learned. The first mistake I made when investing in the stock market is not having my own emergency fund separate from the stock market. When I needed a large sum of cash for an emergency, I had to sell my stocks way earlier than I wanted to because I didn't keep my emergency fund separated. Also, many of you know that credit cards have high interest rates. You'll later find out in this video that the average return of an investment in the stock market is about 10%, but the average credit card interest rate is 14%. So you'll actually be making more money typically by paying off your credit card than you would be investing in the stock market. Okay, so here's the fun part. You may be asking yourself, okay, I want to invest in stocks. What should I invest in? Let me introduce you to Warren Buffett. He is considered the most successful and the wisest stock market investor of all time. He's considered the Tom Brady, the Michael Jackson, the Michael Jordan of the stock market world. And he recommends that most people invest their money in what's called a S&P 500 index fund. Remember, we talked about that index earlier? Well, you can buy a fund that mirrors all the stocks that's in that index. Let's zoom in into the S&P 500 and see what exactly is inside of it. So over here, you'll see there's 11 different industries. So it's well diversified. And diversified is just another way of saying that you don't have all your eggs in one basket. Now, the S&P 500 index fund, their goal is to have the leading companies in each industry represented. They have high standards, so not every company that exists in that particular industry will make the fund. You'll find a lot of different types of companies in the fund. There's banks, car companies, internet service providers, food, beverage companies, technology companies, and so much more. Now, if you bring attention to these larger square boxes, you can see they're a lot bigger than these other boxes that's represented in the index. The reason being, the index is weighed more towards the companies that are performing better or just essentially making more money. So pay attention to these larger squares here. Yes, there are 500 companies in the index, but they give more weight or a higher percentage of the pie to the companies who are larger or who are making more money. So these larger, true money-making businesses will move the index more than the companies that aren't making this much money. And when the day comes that the company just isn't making as much money anymore and isn't meeting the high criteria to be part of the index, well, it's shown the door. It won't last in the fund. So it's kicked out, and the next new up-and-coming company will come in. Now let's look at the performance of the S&P 500 index. So if you average all of these returns together, the average winds up being 10%. You can see a steady, gradual increase in the fund. You also can see a few dips along the way. Most recently, in 2008, that's when a lot of people lost money in the stock market. But if they were able to keep a long-term view and hold that money for a little bit longer, it didn't take that long to return to not only where it was, but to continue to increase. Now, wrapping this up shortly, there's 3 things that I want to leave you with. You want to limit the amount of individual stocks, individual companies that you invest in. Many of the financial experts recommend that you have most of your money that's invested in the stock market to be in an index fund, particularly the S&P 500 index fund that we spoke about. Now, I'm not insulting your intelligence. You might be able to pick some really good companies who will do well. But consistently, it's hard to make as much money as you would by simply just investing in the index fund. Most of the professionals who have billions of dollars, they have a hard time beating the S&P 500 index when they pick individual stocks. So if it's hard for them to do it and that's their full-time job, you may find it hard to do as well. You'll want to avoid high fees. So if you invest in a mutual fund with your company, your 401k, or your own account, pay attention to how much fees you are paying. So for this example, let's say you invested $300 a month for 34 years and average a 10% return. If you were paying a fee of just 0.14%, this is how much money you're left with. But if you raise that up to just 1%, 1 full percent, now you have less than $1 million just by fees alone. And the last thing I would warn you about is trying to time the market. What does that mean? It's trying to predict when the market will go up or when it will go down. So let's look at one particular study that was done from 1996 to 2015. So through those years, the S&P 500 index returned 8.2% a year. But if you missed only the top 10 trading days, the top 10 days where the stock market rose, those returns will be cut in half to 4.5%. Now, you don't know when those 10 days are going to happen. You just simply don't. So you don't want to miss out. I'm going to stay in the market. I'm not going to pull my money out and jump back in and jump in and out. As you can see in that previous chart, all you had to do was stay in and eventually it rises. So avoid pulling your money in and out. So this is honestly the most exciting part of the video because it shows you that if you started today with nothing, $0 invested in the stock market, but you started today, let's say you're 30 years old, whatever the number may be, but just give yourself 34 to 35 years to stay invested in the stock market. But every month, you just put away $300. We saw that the S&P 500 index goes up on average about 10% a year. If you do that, you had only put away $126,000. That's only 11%. The $126,000 that you sent to work to make money came back and returned to you $1 million. Getting started. So we talk about brokerage accounts. So you open up a brokerage account with one of those companies that was listed or one that you may have heard about or through your bank. You have to choose what type of account you want to open up. Retirement accounts, such as an IRA or a 401k, they have more tax benefits. Now, you may not be able to touch that money that's in those retirement accounts without paying some type of penalty. But if you're in it for the long haul and you have an emergency fund, you don't have to worry about touching that money. So once you decide what type of account you want to open up, then you start to buy index funds and you do it consistently. And we know that index funds is just a list of stocks. Now that the presentation is over, rewind, go back if you need to, write down your list of questions, and reach out to me. My contact information is listed below. And the last thing I want you to do is please share this with your family and friends. If this was good information and helpful information to you, share it with them so we all can get wealthy together. Thank you for your time.